there, it's Seb the Realtor here. Have you been wondering what's going on with getting a home loan here in Santa Cruz County? Prices are way up, mortgage rates are way up, affordability is way down, buyers are getting creative, sellers are getting creative, lenders are getting creative. What is that looking like in terms of your actual experience as a potential home buyer here in Santa Cruz County? And should you even buy a home right now? What with what's going on with mortgage rates and prices and all that stuff? Well, to answer that question, I had a Zoom meeting with Victor Romero of Santa Cruz Lending, and we chatted for, I don't know, something like an hour. And he unloaded a whole bunch of information on me, which I really appreciated. There's some stuff that I didn't know, which I learned, and it was very fascinating and worthwhile for me. And I know this information is going to be very, very valuable to you as well if you are considering buying a home here in Santa Cruz County and getting a mortgage loan. So without further ado, check out my meeting with Victor Romero. All right. So for those of you who don't know, this is Victor Romero, and he is the best mortgage lender in Santa Cruz County. And that is why I wanted to have a little chat with Victor and just sort of touch base and see what's going on with the mortgage business from his perspective. Because mortgage rates have risen so dramatically, so quickly that it has really very rapidly transformed the Santa Cruz County real estate market and actually markets coast to coast. And so I thought it would be very, insightful to talk to Victor and hear what he has to say about our local mortgage market and the real estate market. So, Victor, tell me, what do you think? What's your perspective as one of the premier lenders here in Santa Cruz County? What do you think is going on here with our market and the mortgage rates and all that good stuff?
Hey, thanks for having me. First of all, Seb, it's always a pleasure talking to you. The market is slowly changing. We saw an uptick in rates starting in January. December-ish, November-ish, we were seeing 2.8, 2.7. And today we're probably pricing out anywhere between 5.25 to 6.5, depends on the program and product. So we've definitely seen inflation there with rates. And so really looking at this nationally is important to get back to the macroeconomics that's going on here in Santa Cruz County. Nationally, what was going on is a large amount of inflation going on in housing. I think the last 12 months, we saw 20% plus appreciation in homes. That type of level is unsustainable. So knowingly, the Fed, what they typically will do when inflation becomes an issue is they'll increase what they call the federal funds rate. The federal fund rate actually has nothing to do with mortgage rates because the federal funds rate is tied to short-term loans. You're talking about your business loans, your car loans, credit cards, things like that. But they also have other instruments that they use in order to influence interest rates in the long term, the 30-year fixed rate loan. So what they have done and what they feel that they need to do in this market is increase rates nationally, and that's what has happened. Rates going basically doubling in such a short period of time is historic. Never happened in the history of 80 years of interest rates. I think this is the fastest and most aggressive increase in rates we've ever seen. So the system, the economy, it's huge. So it takes time for these types of changes to work their way through the economy. So what initially happened is that when they first started going up at this rapid pace, we started seeing a decline in the amount that people were qualifying for. We're talking February, March. Really a pivotal part was probably around the end of March. That's where we could really sense that the market was changing from a very aggressive seller's market to balancing out to what seems to be more of a normal market. There's still a lot of activity as far as clients getting pre-approved and looking into the financing, a little bit more nervous about what's going on in the economy. Going back nationally, so they increased these rates to essentially make it more expensive to have access to money. A lot of my clients ended up now qualifying for $50,000, $100,000 less than they were back in December. Those clients that are no longer qualified for the price point that they were competing in are essentially out of the market temporarily. Temporarily is really as long as it takes for wage inflation to catch up, for their pay to increase in order to qualify with these new rates. So these clients being off the market would allow the clients that are still qualified to have a better chance in purchasing a home. A term that's coined with what the Fed is doing is called demand destruction. So they're essentially trying to reduce the amount of demand that's out there for goods and services, housing being one of them. I think the definition of inflation is too many dollars chasing too few products. So we were in a situation where we just came out of COVID. 2020, they dropped the rate dramatically, made money accessible very cheap. This is what drove up the market because affordability was high. Now they're doing the inverse. So we got to remember, I guess, the way that the Fed works is with this manipulation of the interest rate. Whenever they want to slow down an economy, they will increase the rates. When they want to speed up the economy, they will lower the rates. So right now we're in an increasing rate environment because they're trying to essentially pump the brakes on the economy. Imagining somewhat like a car on the freeway, you're driving along, we're going 85, they really want to reduce it back to the speed limit of 65, so they slightly, or in this case, pretty rapidly, pump the brakes to get the car down to 65. They don't want the car to go to zero, and they don't want the car to go in reverse. But what is true in everything that they do and in history is they always overdo it. They always over stimulate, or in this case, they've perhaps gone too high too quickly for the economy to try to absorb this. So what's going on nationally is that we're already seeing a slowdown in the amount of sales. Inventory is rising. We feel that the inventory rising, this is more of a seasonal adjustment, because really there's a lot of clients still out there and borrowers that see the value in purchasing a property, appreciation, tax deductibility, and the fact that rents are expected to continue to rise at a minimum of 5% this year. So the fundamentals of housing are still there. There's still demand there, but there's a reduced amount of demand. As far as inventory, it is building. I think we're at like 2 months inventory. In general, 6 months supply is a balanced market. 6 months and below an inventory is a seller's market. 6 months and above is a buyer's market. So right now we are still in a seller's market. And Seb, you probably know better than I do as far as when you put in an offer or what you're seeing in the real estate market. What are you seeing as far as properties on the market? Are they sitting longer? Are there still multiple offers? Things like that.
Well, that's a good question. And, I just did my June Santa Cruz County real estate market update where we looked at the May numbers, and homes are still flying off the shelves. They're still selling on average last month in May in 11 days on average, which is really, it's like historically fast clip. But what's interesting is that the number of homes which sold in May this year versus May a year ago was down right around 30%. And that is a really big year over year drop. So from my perspective, what happened with this, especially this latest rate hike by 3/4 of a point, or 750 basis points, you guys say, was that the market like it put on the brakes. It was interesting, right? The whole market it didn't grind to a halt. It wasn't like when COVID hit. When COVID hit, the market actually did literally grind to a halt. But it felt like the market really like just slowed down by like 75% or something like that. And but it feels to me like, the market basically is taking a beat or several beats to adjust to this new substantially higher lending cost. And that once that all gets sort of like absorbed emotionally and factually by the buyers out there, I suspect that we're going to continue to see a more normal sales pace in terms of how many homes are sold month to month. The big question is what's going to happen, to me anyway, with prices, and prices in May were just about flat with May a year ago. They were down like 0.1% or something like that. So they weren't up at all from May a year ago, but they are not crashing down, at least as of May. But I don't know that the full number of these higher interest rate loans are going to be reflected in that number.
Yeah, and for the individuals, or sometimes we hear things either in the news or blogs about a housing crash. We're really not seeing that at this present time. We are seeing a reduction in qualified, able, and willing buyers. Part of that might be the nervousness around the market. There are plenty of qualified buyers. Seeing the value in housing is harder during the times the rates are high because you're looking at that large payment. But comparably to market rents, after factoring in possible next 5-year appreciation, the tax deductibility, and then also the hedge against your housing, it's still a very, very good place to put your money as far as an investment tool. As far as where we're going in the future, it really depends on whether we are done or not with this increased rate environment. So right now, the official inflation number, I think, stands at around 8%, I think is what I read the last time, where core inflation is about 5%. So if we try to take a guess on where we are at as far as mortgage rates, if you take a look historically at where interest rates land compared to where inflation is, typically mortgage on the 30-year mortgage rate is typically 2 to 3% above the core inflation rate. Hypothetically, if today's core inflation is 5%, rates should be between 7 and 8%. What the Fed has been doing, they expect the core inflation rate to come down by the end of the year to around 3.5%, which essentially says 3.5, 4.5, 5.5, that we are basically where we're going to stay when it comes to interest rates. This is where we feel in the industry that we're leveling off. Can they overdo it? Can they go to 6% and 7%? Yeah. Will it happen? Nobody knows. Your guess is as best as mine. If you take an educated guess, we're feeling that it's topping out as far as where we're at. So we've already gone through the increase. Now, like you said, we're getting adjusted to where we're at. So now that we're here, what happens as far as affordability and how do people qualify for housing? That was one of the big questions. How do we get people into homes in an affordable manner? And that's where a lot of banks, mortgage banks, brokers, these banks are coming up with products. Either the 5-year adjustable rate mortgage is coming back in style, I'm not sure how long you've been in the business, Seb, but I'm sure you remember these products from back in the day. There's no negative amortization, but their interest only is peaking its head. And what that does is it helps with the payment amount per month. And with the savings in the mortgage payment, when you get into the product, the idea is that you'd be able to utilize this financial tool to refinance in the next 2 to 5 years when it is expected that the rates will dip again. Will the rates dip again? Once again, educated guess. I believe I was sharing a slide with you where after every recession for the last, I think we had agreed is the last 8 recessions that we've seen, rates have come down after the recession, which makes housing more affordable, which increases the value and increases the demand and increases the prices. So if we hit a recession, which I think the R word is what everyone's talking about, initially, yes, it will impact our business as we are seeing. My total guess is that we're already in a recession. We just don't know it. A recession is categorized with 2 negative quarters of GDP. I think that's the definition. And the second quarter will come due, I think, next week, I think is the report. So then we'll reaffirm whether we already are or not. And from there, how long will the Fed allow us to remain here before it's too painful? They reverse course and then start cutting the rate. So can it be as early as next year? Perhaps. It just depends on how much pain we need to go through to get inflation back into control. But as always, they've always done this. Historically, they increase it too much and then they decrease it too much. So decrease is coming anywhere between 12 months, maybe 3 years. No one really knows, but whoever's buying in today's market, getting a great deal, have locked in the price and able to refinance in the future. And that's where these hybrid products like the ARM, adjustable rate mortgage, is coming out. There's another one we were talking about. What were we talking about? Oh yeah, there's this old school product called a 2-1 buy down. Do you remember that one, Seb?
I remember buying down the rate, but 2-1 buy down does not sound familiar.
It's a temporary reduction in the rate that's limited to 1 or 2 years. You pay, or a lot of times if this becomes more of a buyer's market, you'll have the seller credit the buyer, say 3%. You use that 3% to buy down the interest rate from 5.5 to say 4%. With that 2%, let me rephrase that. So the seller will give the buyer 3% of the sales price as a form of a credit. From there, the buyer will take those funds and artificially buy the rate down temporarily for 1 or 2 years to where the rate can start off at, say, 3.5%, go to 4.5%, and then go to the natural rate of 5.5%. But by then, hopefully rates are lower where they can refinance. It's a way that banks are trying to get creative to maintain affordability in the short term, with the understanding that rates are going to be lower in the future. And once again, it's an educated guess. I don't want to call it a gamble. Educated guess in a sense that we know what the Fed is typically used to doing in these sort of scenarios.
So, Victor, I seem to recall after the last open market committee meeting, or whatever it's called, that the chairman of the Fed is saying they are still planning to continue raising interest rates this year. Did I misread that, or?
So that is correct. They're going to continue to increase the federal funds rate. They're at a 1.5%. My speculation is they're going to get it all the way to 3.5%. So we are, or maybe 3%. So we're about halfway there. Contrary to the belief is whenever they increase that rate, typically it is good for long-term rates. And I understand that sometimes it doesn't make any sense. And the reason it doesn't make sense is, once again, that federal funds rate that they're talking about are short-term rates. It's a direct impact to inflation. Okay, so when they increase that rate, indirectly, the market thinks, hey, they're doing something about inflation. Hopefully it comes down in the future. Maybe it will come down. And when an investor that's holding a 30-year note, like when a lender lends a borrower a note for 30 years at 5%, what they're saying is, I'm lending you this money at 5%, but this money is essentially being taken away through inflation over these 30 years. So I'm going to require more of an interest rate on this money, because it's going to be worth less in the future on this fixed payment. So when the Fed increases the short-term rate, what ends up happening is, the thought is that inflation will drop, and investors on 30-year rate notes feel more comfortable that the Fed has it under control, so they will not change the 30-year fixed rate loan. Does that make a little sense?
That does make sense, but yet when they just raised their overnight rate by 2%, mortgage rates shot up basically exactly 2%, right, or very close to it. I know they don't normally, rise and fall in lockstep, but this last time it sure seemed like it was just a direct and immediate reflection of the federal funds rate.
So I kind of see it like the movie Wizard of Oz, when you don't know how the wizard is pulling all these levers. So one of the levers that we're talking about is the federal funds rate. The other lever that they're pulling is when we hit 2020 March, and they needed to shore up capital for banks. One of the things that they did is they started buying 30-year fixed rate bonds, mortgages, basically. They bought billions of dollars.
Trillions, right? Trillions and trillions, I thought.
Trillions and trillions. So they bought a lot of these mortgage bonds. So they were the number one buyer of these mortgage bonds. Okay. What that did is that anytime a bank would put up for sale a mortgage, it would get sold right away. So that caused the price to come down. Okay. That huge buyer of these bonds. So in this most recent run up in mortgage rates, what they started doing, and the reason that the rates went up, partially because of inflation, the other part is because they said, we're not going to be buying as many anymore. In fact, we might go to buying zero. And the market took that as like, oh my gosh, the biggest buyer is no longer going to buy. We better adjust our numbers here to make sure that we're still going to be profitable in the next years to come. And that's what shot up the interest rate. So now that the Fed has remained strong as far as, we are going to tackle inflation, has calmed the 30-year fixed rate market down to the point where they're like, okay, they have it under control. We understand that by the end of the year, inflation might actually come down. We're going to leave things as is. We understand they're not buying as many mortgage-backed securities anymore, but there's enough demand in the market to be able to absorb what we're selling now. So, right, for the time being, even if they increase in the next meeting, it will have very little impact moving forward on the 30-year mortgage rate. So, long story short, we feel that we're kind of plateauing when it comes to mortgage rates. Now, if in the future we see inflation still continue to rise, yes, that will have a direct correlation to future increases in the 30-year fixed rate loan.
So what you're saying, and this is something that I've never actually heard before, it's the tapering, right? Because the Fed is talking about tapering their bond buying. It's the tapering that actually caused the mortgage rates to spike, not the increase in rates, which were announced at the same time.
This is correct. And so the increase in rates, if it were just the increase in rates, it would actually help 30-year rate mortgages, because they're like, hey, the firefighters here, they're going to, put out the fire. we're going to be comfortable. We're going to be fine. We're going to be safe. But it is the tapering, 100%.
Okay, well, that's very interesting. I'm glad I'm asking you about this. Don't you have like a degree in economics or something like that?
I did
Finance?
graduate with a managerial economics degree.
There you go. See, it's that all that money paid off right
It comes
now
back.
because my mind's blown, right? Like I'm actually learning stuff right here. So, how does all this show up in today's market, right? So you're a home buyer. You work with mostly home buyers. I work with mostly home sellers, although I do work with buyers too. But how are you seeing that in today's market? Are buyers like offering less? Like how much less are they getting approved for? Are they having the seller pay gigantic amounts of points to buy down the rate for them? Like, because I'm getting emails all the time from mortgage people saying, "Hey Seb, how about this? Why don't you have your seller like pay like 30 grand in mortgage, I mean in points to like get down the borrowing cost for your buyer?" And I'm thinking, I got these emails like in 2007 all the time. And so what are you seeing in terms of how these mortgages are actually structured and how offers are structured for Santa Cruz home buyers today?
Well, so currently, like I said, there's still a lot of demand. So we are getting active applications every week. In fact, I was keeping track of our applications, and our applications are only down 20% versus I think industry-wide is 50%. So Santa Cruz County has remained strong because we have the Bay Area and so much access to employment. When we get a client in, we go through the regular process of getting them completely underwriter pre-approved. That gives the client the best opportunity to find a property. When we're going through the numbers, what I've seen with buyers that I've been working with is a lot of the times, because they've read and prepared for this position to be in, a lot of buyers are qualified. So there's a lot of very qualified buyers. But I believe I referenced to willing and able. So the willingness is the other part. And that's where it's our responsibility to show clients and educate clients about the market. The way that things are going with rental, and it really depends on per client basis, the way that things are going with rentals, rents are going to continue to increase in this area. So if you would have bought a house, say 30 years ago, would you be in a better position now? Yes. If the rate was 7%, would you have been in a better position now? Yes. If it was 3%, yes. So the rate is almost irrelevant to the payment amount. So one of the things that, well, some of the things that lenders are doing is that, like I said, they're trying to come up with creative ways on qualifying borrowers, where the calls that you're getting on things that we were hearing back in 2007 are the same kind of tactics that were used back then, with a spin on them that now everything is on the 30-year, as far as everything is purchased by the federal government, as far as backed by the government. So there's certain rules that banks have to follow. We're not getting into the neg am or stated or anything like that. Everybody still needs to qualify. So the buyers that are buying today are still qualified. It's just the banks trying to come up with reasonable ways of managing this payment environment. So with what's going on, when a client is pre-approved with us, they're going out in the market and shopping around. When they're putting in offers, I've seen a lot of different things happen. One, you have a property that is purposely underpriced. They want multiple offers. They want to, you do the trick where people pin each other against each other and get the price up. So that's still out there. That's still active. That's still happening. You get the secondary option where the home is priced correctly, and they might get two offers, and then you're just going to get against someone else. But at that point, you're talking about property that might be 900,000 in the valley, or 800,000, or $1 million. In those price points, it matters what the client thinks. I just had one today where the client withdrew their offer. They didn't even wait to the seller to respond. There's only 3 offers on the table. So there's the nervousness of the situation of having to take on this mortgage payment that's going to have a direct impact on that specific property. And then there's a market, then there's the price points the market of the homes that are just stale. They're just overpriced or probably overpriced because of the amenities that it has. So it is definitely a hit or miss. A lot of my clients are still active, still looking, still wanting to buy, but becoming pickier. This is going to continually happen for the rest of this year, to the point where our 2-month supply might go to 4-month supply, might go to 6-month supply, and we're finally going to have some sort of a balanced market. Of course, we all wish for that, but balanced market never exists. It's always one way or another, right? So will it go to where it becomes a buyer's market, and then your seller says, you know what? My house is 1.2 million. Sure, I'll give the buyer an extra 30,000 to try to make the payment more affordable, if it means that I'm still going to get the bulk of my money. As far as sellers, I am starting to see that certain sellers are getting worried about what's going on. And this is exactly where the Fed wanted it. They want to instill some fear to get things going, to get, like I said, demand destruction off, and then also to get some deflation as far as these prices. Are we going to see a prolonged decrease in prices? I don't think so. It just depends on how long we go with this. Does that answer your question?
Well, except I wanted to know about these seller paying points. Is that really actually happening, where sellers are buying down the rate for their buyers? Have you actually seen that in the wild, or?
I have not seen it yet. It's completely allowable. Typically, on a conventional loan, 3%, you can use 3% of the sales price to either buy down the rate or pay for closing costs. On the government programs, FHA and VA, I believe is 6%, which is a hefty amount depending on the price point. But I haven't seen it in the wild like you mentioned. I think that it's just a matter of time before we start seeing that. It just depends. Housing is not like buying a TV, right? It's a 30-day process, or 20-day, or 15-day, depends on your escrow. But it's a process that takes time. So it's going to take a while for sellers to get accustomed to the new normal. And they don't know what the new normal is, because no one's seen really the impact on these rates. We're seeing a decrease in demand already. So obviously that's going on, but it's going to take a few more months to really dictate on where the price points for some of these properties will be. When we get to that point, then we can have a different conversation and be like, hey, Seb, now I'm seeing it. Now I'm seeing how sellers are really accommodative, whereas before they were not accommodative. And right now they're somewhat accommodative, because they're already starting to feel that they're not, you get a couple of people going through an open house unless the house is really well priced. So I think that we're in the middle of making history, but we're in the middle of it. So we'll see in the next couple of months going through the summer how things pan out for the rest of the year. My assumption is that the rest of the year will be like now, where it'll be very limited amount of sales with the current interest rate environment.
And are you seeing buyers buy down their own interest rates? Are you seeing buyers pay a point or two or more to buy down their own rate? Or is that just not, people are just sucking up the higher rates?
That is a great question. I love the fact that you asked that question. The advice is, do not pay points right now if you cannot pay points. That is the advice. That is, every professional will tell you, do not pay points right now, because this temporary increase in rates is temporary. So why are you going to pay so much? Why are you going to front load your mortgage so much to where you're not going to get the benefit of that if you end up refinancing in a year and a half or 3 years? But with that said, it's hard to swallow a 6 1/8 rate on your mortgage and a mortgage payment of over $5,000, $6,000. So although the professionals tell us don't buy down your rate, the industry is showing us that people want to buy down their rate, because it's about the monthly payment and affordability. So what I've seen is more than 80% of my clients are buying down their rate to make the mortgage more affordable on a monthly basis.
Okay. And how about like ARMs? Are you seeing like a return to ARMs? I mean, That's the other thing I'm getting from mortgage people. They're saying, hey, tell your buyers to get an arm. And in fact, the last buyer I closed, he did get an arm. He got a 10-1 at a very, very low rate, like 2.25 or something like that.
Oh,
And he's thrilled to the gills because he has that for 10 years. Sounds fine to me. He asked me, Seb, what do you think? I said, I think that sounds great. Because most people refinance way before 10 years, right? What's the average length of time they hold the mortgage? 5 or 6 years, something like that?
6 years, yeah.
6 years. So are you seeing people switch to arms now, getting out of the 30-year fixed, or what are you seeing?
It just depends. I mean, a lot of my clients, I mean, it's kind of a divided camp. You either have big, huge, large down payment that you're like, oh, I'm like 55 plus. I don't want to deal with the paperwork later, and I don't want to deal with the added stress of having a time period where my mortgage becomes adjustable. And then I have my poor first-time home buyers. I would say poor first-time home buyers because they have to deal with this market. With my first-time home buyers, they are less apt to be risk takers when it comes to arms. But I am noticing that the spreads on arms, for a little while there was no market for arms. But now it's slowly opening up to where it is 0.5%, 1%, or in your case, that's a phenomenal rate that I'd love to know what investor was at. But regardless of that, you could see 1.5% in rate better. When you look at it as say a 5-year arm that's priced at 4.5 and your 30-year fix is at 5.8, what you need to really do is calculate out what those savings are, figure that you're only going to be there 5 years, and that either that savings you put in your pocket or that absorbs the additional year, the 6th year, of the fact that your mortgage is now adjustable. So it might adjust 1% upward at the 6-year mark, another percent on the 7-year mark. So you are essentially at today's market rates after 7 years because 2 of the years have adjusted. The payment savings you had during that time should offset that extra 2 years. And by then, my thought is that you would have refinanced by then. Other aspects of that, if we are prolonged recession, you lose a job, things like that could have an impact in that. But for the right situation, an ARM product is a good solution for a client.
How about interest only? Is that a thing again, or no? You're not doing any of those?
We're in the infancy stages of interest only, so it's going to be probably another 6 to 12 months before we really see more products roll out with an interest-only option. The biggest buyer of mortgages is the government, Fannie and Freddie. Fannie and Freddie are buying, if I had to take a guess, probably more than 80% of mortgages out there. So as soon as they find a way of structuring an interest-only product into their portfolio of products, then it's going to be widely rolled out by pretty much every single investor. But right now, infancy stages, interest only. I could see maybe interest only coming back for a duration of time, maybe a 5-year interest only and 25-year amortized loan, where the loan is fixed, but you have a grace period of 5 years of having interest only. But I haven't seen it yet. There's also alternative programs and investors. Alternative programs and investors are banks who do not sell their mortgages to the government, to Fannie or Freddie. They make their own rules. Typically, rates are higher on those programs. I just priced one out on an investment property, and the rate they quoted me was 8%, which I thought was ridiculous. But they offered an interest-only option with it. So that made the effective payment feel like a 6%. It was a bank statement loan where my borrower did not have tax returns that would support a qualifiable income. And so for that borrower, maybe that was the best product at this time. Ultimately, over time, they do their taxes, they can qualify in the future. But that's the kind of challenges that we're running into when it comes to products and programs.
So people are by and large sticking with the 30-year fixed rate mortgage, and the sellers are not paying points, and buyers are maybe paying a few points, but the guidance is not to do that. So what are buyers doing? Are they just sucking up like a mortgage payment that is like, $1,000, $2,000, $2,500 more per month than they were like 3 months ago? Is that what you're seeing? That mortgage payments have jumped that much for your average buyer?
It depends on the buyer, but yeah, I mean, we're seeing $1,500 more than what people were paying in December. And that's the part where maybe you and I agree that there will have to be some sort of adjustment in prices to get that buyer back into the market. We need to remember that housing is still a person's place to live. So there are situations that people need to buy a home because that is the next step for them. We're seeing a huge influx in what is the baby boomer millennials, right?
Millennials, yes.
Millennials probably constitute 80% of my buyers right now.
Are you a millennial,
These are,
Victor?
I missed it by a year. I think that's what it is. Although I'll put myself in there. I feel, in my internal soul, maybe I am
I'm a Gen
soul,
Xer.
millennial.
I hate it. I hate being a Gen Xer. I wish I was a boomer, but no, not that old, unfortunately.
Yeah, so millennials are coming into the market, and a lot of them have lived with parents a long time, have a couple kids, maybe saved some money in their 401k, and now in a position to be able to buy. They a lot of times are tech workers or some sort of professional. What do they call it? Is it white collar jobs? Is that what they
White
call
collar
it?
jobs, yeah.
White collar jobs, working from home. So a lot of my buyers are millennials. And you got to remember, you and I have been around so long that we remember prices in the 300s into 200s. If you're out there looking at housing prices right now, and this is the first you've seen of it, this is what it is for you. A typical 3-bedroom, 2-bath in Watsonville is 800,000, 700,000. A typical 3-bedroom, 2-bath in Santa Cruz is 1.3 million. Is that what it is now, Seb? You could probably know better than me.
The county median price is 1.29 million.
Yeah, 1.29.
The city of Santa Cruz is probably more like 1.6, and Watsonville
1.6.
Like
so these are the prices. This is what it is. So the fact that the mortgage payment went up by 10% of what it was back in December, for some people, it doesn't constitute enough to be able to have a room for their kids, and the other part that I've been seeing is a lot of help from parents. I've been seeing a lot of parents stepping in going, hey, I know you don't have 20%. Let me offer to gift you 20%. You can talk to your tax preparer about gifting, but pretty much father, mother can gift a child. What is it? What is the gift tax? I think it's $8 million.
Yeah, it's millions and millions.
Who has that much to give? But they're doing these huge $300,000 subsidies in order for their kids to not have to pay PMI, avoid that payment, and then get the payment in a more affordable level. So there's a variety of ways that people we're a species to want to acclimate to the newest new, right? So we're going to find a way to get where we need to get to meet our goals. So I had another young lady who essentially said, I am going to buy a house whether you help me or not. I said, I'm going to help you because you're that determined. And nobody wanted to help her. And she got her mom involved, her dad involved. I mean, it was a whole community project. She bought her house. She bought it with a granny unit. She's going to rent that out. She has a roommate. She's going to rent that out. She's going to make it work. So can people make it work? People will make it work one way or another if the goal is still to get housing. And so the payment, what is the payment? She's going to write it off. For her, she wasn't shopping in December. She's shopping now. The rates are 5.5%. This is what it is. What can I afford with what I'm qualified for? And can I call this my home?
Yeah, and she's going to end up really rich, actually, I think, probably at the end of the day, because those are the kind of people who really do end up, very financially strong after doing that for 20 or 30 years, So that actually is my next question, which is, what is a typical down payment that people are using these days in Santa Cruz County? What are you seeing? Are they getting 20% down or less?
It just depends. I mean, if you're talking in the outskirts of Valley or South County, then you're still getting away with minimum down.
Let's 5%. Say let's call it SoCal, middle of the county. What are the people
20%? What? 20+%.
20+%, 25%.
Because you got to remember, if you put in 10%, which there are products out there for that, or you divide up the loan into 80-10-10 loan, which basically means you divide the first mortgage 80% of the value, and then the next is a 10% of the value, and you come in with 10%. That mortgage payment is pretty healthy, to the fact that a lot of my millennials are just approaching their parents and figuring out what that would look like if they were to help them. And, the parents are offering to give them $300,000 to put in a down payment. Or it starts out with, hey, I want to buy a $1.4 million house. I only have 10%. My parents are willing to give me $100,000, and that $100,000 soon becomes $200,000 or $300,000 from the parents, as soon as the parents realize where their kid's mortgage payment is going to be. So if you look at statistics, I think half of all properties, 70% of all properties in the United States have at least 20% equity in them, something like that. So you're talking, baby boomers having a lot of wealth that has been created in the last 2 years with real estate, stocks, things like that. So there is a lot there. So for there to be like housing crash is not realistic, because even if people default or are close to defaulting on their mortgage, they could easily sell it at a profit still, because the prices are so high. So going back to your question, what I'm seeing is buyers getting help from their rich uncle. Isn't that what it is? The rich uncle from their parents or family.
Yeah, my kids are going to rely on their rich uncle. That's for sure. You hearing that, Uncle Chris? So, okay. So but are you seeing now people maybe not in, or maybe in Capitola, I don't know. Are you seeing people with 10% down actually getting offers accepted? Because back 2 or 3 months ago, you had 10% down. It was like, next. Are you seeing?
Like, for example, I have one in Capitola where we thought we didn't have a chance, and we actually went under price. And we did have a chance. So it's definitely a hit or miss, like we were talking about. It's we're in the process. We're in a process of making history. So it's still a work in progress as far as each property, where they're at and they're priced. You got a very competitively priced home. If you have an overpriced home, you may have an opportunity there to sneak in with less down payment.
Okay, and so the conforming loan limit in Santa Cruz County these days is $927,000, or what is it?
You caught me off guard. What is
972? It's either 927 or 972.
Yeah, 972. Yeah,
972. Yeah. There you go. Mm-hmm. Okay, so it's 972, and that's that's 80% of the purchase price, puts us at about $1.2 million, mm-hmm. right? Somewhere in that neighborhood. What kind of income do you need if you had 20% down and you got this 972 conforming loan limit, and you didn't have a car payment or college debt? Let's just say you had no other consumer debt to speak of. How much money do you have to be making, Victor, in order to pay for a $972,000 with mortgage rates at 5.5%?
Trusty calculator here, Seb. You're making me do math on the spot.
You should never do math on the air.
So the answer is going to be a little more complicated than just a simple number. But if I had to take a guess, I'd say at a bare minimum, $200,000.
$200,000. You got to make $200,000 to pay basically $1 million mortgage.
Yeah, and usually the basic rule of thumb is you take what you make per year, multiply by 5, and that's roughly what you'd qualify for. So as far
No,
as a loan,
I thought that was
so
the rule when interest rates were at 3% or whatever. So that rule still held steady as we go
yes,
higher.
it still holds about steady. Yeah, it still holds about steady. So you were talking 20% down. So there's some other factors in there, but you about $200,000 to get into a $1.2 million home. If you have a car payment, if you have student loans, if you have credit cards, if you co-sign for something, if you have another home, all those are factors that roll into your qualifying. And believe me, things have gotten easier in qualifying as well. Before, with especially with student loans, for example, if somebody's on a payment plan, usually the lender will take the payment plan if it's a structured income-based payment plan. If it's a lot of the student loans right now have zero payments. It has zero payments since March of 2020. With people that have zero payments and haven't paid their student loans for the last 2 years, banks are qualifying on a nominal 1% of the balance amount. And that could be actually lower than what the actual payment could be. Debt to income ratios are being pushed daily.
Yeah, what does that mean? Ratio these days? That was my next question.
Yeah. Well, most of my clients are actually, my office makes fun of me because I'm always at 49.9, which is a 50% threshold. There, just because people are really reaching for that property.
Right.
But yeah, ratios can go up to 50% on a conventional loan, regular cookie cutter loan. Anything government usually can go higher than that. If they go, I had a VA go to 60% back end, which is crazy to me, but that's an entitled program. They deserve the program. They deserve to get a loan. They get, the red carpet rolled out. So, but on average, most clients are between 43 to 47% debt to income ratio.
And that's your total debt, right? So
like not total debt, including the housing.
So that's the back end ratio or the front end ratio?
We're talking back end.
Back end ratio. The front end ratio is only the mortgage payment only, right?
This is correct. So a lot of times what'll happen is when I get a client in and they're barely squeaking by, we'll look, usually if they have extra assets, I'll consider paying down or paying off some of their debt to free up the monthly payment amount in order for them to qualify for a little bit more. So they have 2 car payments that equal $1,000 a month. You pay off the 2 car payments, and then all of a sudden they qualify for an additional 200,000, 150,000, something like that.
Okay, and so let's just say you don't have a rich Uncle Chris, and you don't have 20% down. Are there any, and this comes up all the time, are there any down payment assistance programs or first-time buyer programs anywhere in the county that currently have any money that are actually helping people with their down payments? Or
yeah, you'd have to go to South County or properties priced under 600, which I don't know whether you can get a house for 600 or a condo, maybe condo. But the city of Watsonville has a program where they'll lend you 25% of the price of the home up to a purchase price of $650, which for a condo in Watsonville, maybe you could get. The program from County of Santa Cruz has the same type program, but we're facing the housing crisis. Everything's just too expensive. And these programs that get funded by the state, partially to the federal government, have not kept up with the pace of housing appreciation, housing inflation. So they've been one step behind. I know the Santa Clara's tries to keep up. I think their program goes to 800,000, but 800,000 in Santa Clara County is nothing, right? So I think that there's just been a delay there with these housing programs and affordability, because now the price points are getting so big that if the program allots, $2 million to be spent on first-time homebuyers per year, and your price point is 1.2 million, you're only going to be able to help maybe 10 people, right? Where the program was designed to help 30 people. So there's some tinkering that needs to happen there. Is there programs? There is programs. There's a Cal HFA program that's a grant program that you can apply for that will serve you well in lower priced areas. And what it does is you come in with your 3% down, they'll lend you 10%, and you get a loan for the remainder. And that 10% after 5 years gets waived, gets forgiven after 5 years. So that's a fairly nifty program. You have to use their first loan program, which the rates aren't great. That's how they recover some of the expense of the program and the forgiveness of the loan. But you have to apply through their program. I think the loan limits on that program are, I want to say 700,000. So it definitely be something that's going to be utilized more Central Valley, somewhere like that, maybe South Monterey County.
That's Cal HFA, and
Cal HFA.
That's a restricted to certain lenders. Like you can't do that loan, or you could do that.
Well,
loan.
Yeah, you have to be approved by Cal HFA to originate, approve, and fund those loans, and we are approved.
Okay, you are, and so the city of Watsonville does have some down payment assistance for first-time buyers. And do those also qualify for those affordable housing units, the few that there are in Watsonville? Could you get 25% for those?
Typically, no, in the regular market. But I was speaking with a source, unnamed source, that said that they are very, very aggressively marketing their program, so they want to lend their money. If you have a well-qualified borrower that fits their parameters, it's looking entry level, is okay with a condo or okay with an affordable housing unit, I would probably say do not pass up the opportunity to at least ask the question. And they have the money. It's a use it or lose it. So if they're not lending it out there, next year they're not going to get it. So they were very, very aggressively marketing the program.
That's good to know. And wrapping things up here, VA, FHA, VA has 0 down payment required, and FHA only 3.5%. Are you seeing more FHA or maybe VA buyers out there, or still not yet?
I'm typically seeing VA a lot more, with the 0 down payment, no PMI, 100% financing to, I don't even know what limit they go to, $2 million or something.
Big limit,
ridiculous, like that. I'm seeing a lot more of that. The rates are great. FHA, not as much. And the reason is their PMI that they charge on an FHA loan is extremely expensive after you get up above a loan amount of $625,000. It's equivalent to more than 1% on the mortgage rate. So if your mortgage rate on an FHA is 5.8, imagine like you're going to be paying close to 7% on that same mortgage. Not that that's the rate, that's the effective rate after you take into account the PMI that you've been paying for the program. Right. So it's not very popular right now, and they're already talking about doing some tweaks to make it a little bit more popular of a type loan, but nothing's happened. My hope is that Hawaii typically, for example, is considered a high cost state. And so they get special treatment from FHA. And so their FHA loans are something ridiculous, like 1.2, 1.3 million. That would be great if you can open something like that up, because they will also change conventional loans. But I guess we're not high cost yet because of the Central Valley, but there's always hope.
There's always hope that the cost can go even higher. So I want to say a couple of things here. And first of all is, when is the best time to buy a house? There's 2 best times. One is today, and the other time is 20 years ago. And I want to point out that if you had bought a house in 1988, and then the real estate market crashed, which it did in 2008, guess what? You still made a ton of money on your house, right? I mean, like, what were the prices back in 1988? I don't know, 250, something like that. And what would they have been then at that point? 790 or something like that. I mean, like, so you would have done just fine if you have that long window to own your house, which is what I suggest that everybody do, because the years fly by quicker than and just realize that real estate works best as a long-term investment. And even buying today, the prices may seem high today, but that's only compared to where they were yesterday. When you look 10 or 20 years in the future, I think it's going to prove that prices are actually still cheap. And the other thing I want to point out is that I would much, much rather have a lower amount of debt than a lower interest rate, right? Because you can always refinance if rates drop, but you cannot just shave off $100,000 or $200,000 from your mortgage balance as if by magic. So the fact that rates are rising, I don't think that should really, should really influence anybody in terms of like, oh, is now a good time to buy or not? That's really, I don't think that relevant. I think what really matters is, do you need to have a house right now? And do you want to live in Santa Cruz? And if the answer to, and do you want to live in Santa Cruz for the next 7, 8, 9, 10 years? And if the answer to both of those questions is yes, then for me, it's a no-brainer. You should definitely buy a house. Even now, even if you think that the housing prices are going to go down in the next year by 5 or 10%, it doesn't really matter, because if you're buying for that long haul, and versus continuing to rent that whole time, it's pretty much a wash, I would say, in terms of waiting to buy. You're going to come out way ahead as a homeowner versus a renter.
Well, I'll tell you this, every single person, 100% of the time, when I've talked to a client that's been renting for 30 years, and I've had a few of them, every single time, I asked them, do you wish you would have bought? I feel like they want to reach to the phone and like strangle me, because of course I would have wanted to bought 30 years ago. I had the opportunity, and so go on the stories. So to date, majority of my clients are very happy with their purchases, and inflation, whenever you have assets, it becomes a friend. Yeah. So versus when you don't have assets.
Yeah, I remember when I bought my house like 11 years ago, I was like, oh, this is going to be great because inflation is going to kick up and I'm going to make a mountain in terms of decreased value of my mortgage and increased value of my house. And inflation didn't budge for like that whole time until just now. I still made a whole bunch of money on my house, which is all paper money. I'm going to live here forever, blah, 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 But that's the other thing. Yeah, I mean, real estate or any hard asset like that, right? It's a great inflation hedge. So there's many, many reasons, I think, to continue to wanting to own a house. And, I get it. It's really unnerving what's going on, but unnerving things happen on a routine basis. All my life, unnerving things have been happening. I remember growing up with the threat of, nuclear annihilation, right? I mean, that was like a real present thing that happened every single day, right? I mean, now we have COVID and climate change and, coup attempts and like all this stuff, right? But, that's just part of the melody of life, really, right?
We are human beings. We will adapt and we'll move forward.
That's right, exactly. All right, Victor. Well, I've taken up a lot of your time. Thank you so much. Anything you want to say before we wrap this up?
No, I just wanted to thank you. It's always such a pleasure to talk to you. I consider you a very dear friend. Thank you for everything that you always do.
All right. And Victor, what's your phone number? How do people call you to get one of your awesome mortgages?
I'm going to give you my fax number too now. I'm just joking. So you could go www.santacruzlending.com or phone number 831-214-2172. I said it really fast.
I'll put it up on the screen with my amazing video editing technology. So
I'm sure people can get a hold of you or me. Just Google our names, right?
And that is your cell phone number. Is that not your cell phone number?
That is my personal cell phone number.
Personal cell phone number. Right, exactly. So
24/7, kind of. Unless I'm bathing my 24/7, kind of, unless I'm bathing my kids.
Right, exactly.
Maybe 23/7.
Right. And they can text you as well. You're a big texter. Right. Yes. So you can text Victor, call Victor anytime, and he will be happy to answer your questions about all of this, right? Because there's so much to unpack here. We've really only scratched the surface, but I do want to thank you so much because I feel that I'm enlightened.
Thank you, Seb.
All right, Victor, we'll catch you later. All right, well, that wraps up my meeting there with Victor Romero of Santa Cruz Lending. I hope that you found that to be as insightful and as interesting as I did. There's a lot to unpack with what is going on in the Santa Cruz County real estate market and getting a mortgage and all that. And Victor is a great guy to call if you have any questions about getting a mortgage loan here in Santa Cruz County. All right, well, if you did enjoy watching that video, I'm guessing you're probably also going to enjoy some of these videos over here. These are my most popular videos here on my YouTube channel, so please do take a look at those. All right, well, that's all I have for this video. Thank you so much for watching. I really do appreciate it, and please stay tuned.